When you use this indicator, you might get few profitable trades, but overall you end up losing money, and there is one common problem which everyone ignores while using it. To make this strategy profitable, we need to combine MACD with fundamentals. But first, let's make sure we know how MACD works. The MACD is made of 4 different components: the MACD line, the signal line, the histogram, and the zero line. After having MACD on the chart, this is how you're going to use it with the fundamentals. When the line crosses upward, but only if it crosses below the zero line, then you want to enter a long trade. And if the cross is above the zero line, you wouldn't want to enter a trade. And vice versa for the short trade. The histogram has the green and red bars, which shows the price momentum. So if the histogram bars are increasing, it shows increase in momentum. If the bars are getting smaller, there is a decrease in momentum. Now, if you use this indicator on its own, it will work great, but only in one situation, and that is when the price is trending. As you can see here, the MACD is producing long signal, which is perfect. However, when the trend is paused or market turns sideways, the indicator produces false sell signal, which leads us to a very common solution, and that is to combine 200 period EMA. While this solution works great when you want to decide when to enter a long trade or when to enter a short trade. However, you will often hit your stop losses, and this combination becomes even terrible when the market becomes sideways. You're gonna get many false signals. To resolve this problem, we are going to combine MACD with the fundamental method supply and demand zone. So far we know to trade MACD crossover with EMA in a trending market. By combining supply and demand zones, we are going to eliminate false signals. You can either mark recent swing low and swing high as support and resistance, or use a range tool to draw the zones, because zones are much more effective than support and resistance line. So once price come back to these zones, you're gonna use MACD crossover to enter a trade. Divergence with zones. Divergence is a sign of reversal or trend shift. There are 2 types of divergences: a bullish divergence and a bearish divergence. The difference of bar shows that the momentum on recent move was lower than the last move, which is our key to a spot reversal. To use divergence, shift your chart to 1 hour time frame. Here the price is in downtrend. However, the MACD histogram is making higher lows. So we're gonna draw a support zone using 1 hour chart and let the price come back to this zone. Once the price reaches support zone, you're gonna switch your chart to 5 minutes and wait for the price to exit out of the zone. If the price bounces back, we're gonna enter long immediately and target the recent swing high. And if the price goes through the zone, we're gonna enter short on the retest of these resistance zone. But we're gonna use 1 hour chart to establish zones and 5 minutes for the trade entry. And to draw supply and demand zones, watch this video.